Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 4th of August. I'm Daniel Lam, your host for the podcast. The non-farm payroll last Friday is a key point of reference for risky assets over the next few weeks, possibly the next couple of months. Non-farm payroll rose just 73,000, and large downward revisions led to 3-month average at 35,000, well below the previously reported 150,000 for the month of June. The unemployment rate ticked up to a cyclical high of 4.2%, while underemployment rose to 7.9%. Now, the devil is indeed in the details that for the third month in a row, job gains stay concentrated in non-cyclical sectors such as healthcare. Moreover, the July ISM manufacturing also missed expectations. So both these figures are pointing towards weakening growth. This is putting the Fed in a real dilemma. The Fed already took a hit in its credibility back in the fourth quarter of 2021 in the transitory inflation episode. Can the Fed cut rates to support the economy while risking into tariff-driven inflation this time? So the risk now is that the Fed would need ample evidence before making a move, and the slowdown could well be on its momentum. Now, all these translates into increasing volatility in the markets, at least over the next few weeks. On Friday, the S&P 500 gapped down and opened at our first support level that we spoke about last week, which was 6,280, and ended at a day low just above 6,200. Now, we've been talking about consolidation over the last few weeks, and we see the index testing 6,000 and possibly 5,800 over these couple of months. Now, the one saving grace is that the positioning for US equities is not so heavy. It is still just above neutral, and this means a sharp fall is unlikely unless we see more dramatic slowdown in the growth data. But we do see investors increasing their focus upon the high-quality stocks over the near term to add a bit of defensiveness to their portfolio. Now, in the US earnings season, the US hyperscalers have reported very stellar results and overall strong guidance, which trickles down to AI infrastructure stocks as well. So it is a reasonable strategy to be looking to add to US technology stocks in tranches if the S&P 500 does reach the aforementioned levels. Now, bond yields are trending lower after the sharp break on the downside in US 10-year government bond yield to the 4.2% level. So now the 4.25 to 4.5% is a key area of resistance, and one can be looking to add to bonds on yield spikes. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.